If you're a scalper with a small account, you definitely must try out this strategy. This scalping workflow uses previous hour's high and low as fixed liquidity zones. And instead of guessing, I built an indicator that draws those exact levels as a box. When the new hour starts, that box becomes the only area I care about. Watch what happens when price reaches one of those levels and fails to stay beyond it. I'm on 5-minute on gold chart. The previous hour has already finished, and the box marks its high and low. Price breaks below the box low, but I do not sell the break. I wait for the close. The candle pushes below the low, leaves a wick, and closes back inside the box. That failure gives the long. I enter after the reclaim, place the stop below the wick, and target 1 R first. When price hits 1 R, I take 50% off and move the stop to break even, and the second half can run. For this long trade, I trail under the most recent red candle. This is where beginners get trapped. The candle is red, the level breaks, and it feels like the market is starting a real breakdown. A trader sees that break and shorts late. But I am watching something different. I want to know if price can stay outside the box. The break below the box is not a short anymore. It becomes the trap that creates the long. This is my scalping edge. The same move that makes breakout sellers enter late is the move that gives me the reversal setup. This is called a liquidity sweep or a false break. In plain words, price breaks a level, grabs orders, and then comes back inside. If price sweeps below the previous hour low and closes back inside the box, I look for a long. If price breaks below and holds outside the box, I skip the reversal. Now let's add the indicator. Every completed hour gets boxed. The high of that hour becomes the top of the box, and the low becomes the bottom. When the next hour starts, those two edges become the levels I watch. The box removes the "which level should I use" problem. The active high and low come from the previous hour. The color of the box can help you read the previous hour quickly. If the previous hour was bullish or bearish, the color can show that at a glance. But the color is not the entry signal. The only entry idea comes from price leaving the box and failing to stay out. If price is near the previous hour high or previous hour low, I prepare for a possible sweep. If price is in the middle of the box, I do nothing. Now, a box and a sweep are not enough. The setup only matters if price meets certain conditions. Pay attention here. Price moves below the previous hour low. That tells me sell-side liquidity has been taken, which means price reached the area where sell stops and breakout orders may sit. I don't enter while price is still outside the box. The candle must close back above the box low. Now the sellers who chased the breakdown are trapped. I can enter after that close, or I can wait for price to break above the high of the reclaim candle. The stop goes below the sweep wick. That is the long setup. The short side traps traders the other way. Price moves above the previous hour high. That tells me buy side liquidity has been taken, which means price reached the area where buy stops and breakout orders may sit. I do not short just because price touched above the box. I wait for the candle to close back inside. Now the buyers who chased the breakout are trapped. I can enter after that close. The stop goes above the sweep wick. The hidden rule is simple. The sweep gets your attention, but the reclaim gives permission. What used to look like a breakout now becomes a question. Did price escape the box, or did it fail and come back inside? If price sweeps one side of the hourly box and closes back inside, I trade the reversal. If price stays outside the box, I don't fade it. Watch this messy 5-minute chart. Price is chopping through the middle of the box, and I don't like it already. The candles overlap. the previous hour low is not cleanly attacked, and price barely pokes below the box before crawling back inside with a weak close. A beginner buys because the rule said sweep and reclaim, but the stop has to go far below the messy wick. The middle of the box blocks the first target. Price stalls, chops for 6 candles, then drops again and hits the stop. This is where a small account gets damaged fast. The strategy is simple, but a weak version of the strategy is still a weak trade. The strategy didn't fail. I forced a weak version of it. The clean version looks almost boring, and that is the point. Price moves directly into the previous hour low. It sweeps below it with clear pressure, closes back inside the box, and leaves a stop that fits under the wick. That is the version I want. A missed entry is also not a new setup. If price already reclaimed and moved halfway to target, I don't chase. The trade left without me. Look, price is stuck in the middle. The sweep is weak. The reclaim barely closes inside, and the target is blocked. I don't try to make it work. I wait another hour for a cleaner box. This next part looks basic, but it decides whether a scalping strategy survives after entry. Right here, price moves up from the reclaim, and you now have a small profit. This is where the trade starts to feel uncomfortable. You want more, but you also don't want the scalp to come all the way back. This is what you do. So price sweeps above the previous hour high, closes back inside, and I enter after the reclaim. The stop sits above the sweep wick. If the risk from entry to stop is $2, then 1R is $2 of profit. When price reaches 1R, I take 50% off and move the stop to break even. After that, I trail the runner above the most recent red candle. Break even means the stop is moved to the entry price, so the remaining position is protected from becoming a full loss. If there isn't enough room to reach 1R before the next trouble area, I skip before entering. After 1R, the trade is managed, not guessed. Now you know the rules, but better traders know how to separate a valid loss from a bad trade. Watch this fresh hourly box. Price pushes above the previous hour high. The candle sweeps the top of the box, then closes back inside. That gives the short setup. The level is clear. The sweep is clean. The reclaim candle closes back inside. The stop goes above the sweep wick. There is enough space to reach 1R. I enter short after the reclaim. But then price moves halfway toward target, then turns back up and hits the stop. That is a valid loss. The trade followed the rules. The market just did not pay. Now compare it to this second short. Price is already in the middle of the box. The high is messy. The sweep barely takes anything. The reclaim candle is weak. The stop is too wide, and the 1R target is blocked. That loss is not a strategy failure. That is a bad trade. This is where most traders destroy their review. They mix valid losses with trades that should never have been taken. Then they blame the whole strategy. The hidden edge is learning to separate the two. Most traders do not need more setups. They need to stop treating every loss the same. This is trade review or process-based trading. It means you judge the trade by the rules, not just by the money result. A clean trade can lose. A bad trade can win. You improve by removing the bad trades, not by expecting every clean setup to win. Now let's turn this into a practice system before risking any dollar. The danger comes when you open the chart alone and start improvising. You have the setup, but now the chart starts moving fast. That is where a scalping routine matters. Open one market for one session. If you choose S&P, stay with this. Don't jump to gold because it moved faster for 2 minutes. Turn on the hourly box indicator and let it draw the previous hour high and low. The box high and box low are your active liquidity levels. Observe price when it attacks the lower or upper edge of the box. If it breaks outside, wait for the close, or 1 or 2 future candles. If price only touches the level, you wait. If price breaks and holds outside, you don't have a signal. This is how an A+ trade looks like. The box level is clear. The sweep is obvious. The reclaim closes strongly back inside. The stop fits beyond the sweep wick. The target has enough room to reach 1R. If the setup looks messy, don't edit the story until it sounds good. Just leave it and wait for the next hourly box. The hourly box system is perfect when the market is sweeping liquidity and trapping breakout traders. But what happens when the breakout is actually real? If you try to fade a real trend, your small account will get wiped out. You need a second system for when the market actually moves. This is the 3-gate scalping strategy. It is built specifically to grow small accounts. And it does exactly 3 things. It confirms the breakout is real. It pinpoints the exact entry level. And it filters out the fakes. This system takes advantage of one mistake most scalpers make. They enter after an initial breakout, before the market confirms the move. So for my scalping setup, I need 3 things in order. Price breaks one trend line. Price breaks the nearest horizontal level. Then, price comes back, retests that broken level, and rejects it. If one part is missing, I do not touch the trade. Here is exactly how to trade it. Euro-dollar, 5-minute. Price is making lower highs, and I draw a diagonal line across those highs. I only need the line to connect the active pullback, not every candle on the screen. This is your first hidden truth. A trend line break looks like the entry, but it is only permission to prepare. It tells me pressure is shifting, and that is all. The problem is that scalpers treat the first bullish candle like a green light. I did that too. I saw the line break, clicked buy, and watched price come back under the level in 2 or 3 candles. The mistake was not the direction. The mistake was entering before the second gate opened. If price breaks the active pullback trend line, I prepare for a setup. If price does not break the trend line, I do nothing. Now, I need the real filter. I mark the nearest horizontal level, which is the last clear support or resistance, the level where price keeps bouncing. The common rule is to trade the first trend line break. That fails because price can break a diagonal line while still sitting under the level where sell orders are stacked. The better rule is waiting for price to break the last clear horizontal level too. On this chart, price breaks the diagonal line, but it is still below resistance. I am watching it, but I am not trading. If price cannot clear that level, the move is not confirmed. If price breaks the nearest horizontal level after the trend line break, the setup is valid. If price does not break the horizontal level, I skip the trade. This is important. What used to look like a breakout now looks like half a signal. That shift alone cuts a lot of bad scalps because you stop reacting to the first candle and wait for the market to prove the level is gone. Now comes the entry zone. 2 breaks show direction, but they do not give me a clean entry. If I buy the break itself, my stop has to sit too far away, and the $100 account cannot survive wide stops repeated all day. The retest solves that. A retest means price comes back to the broken level. I want to see that level reject price, which means price touches it and then pushes away. If price retests the broken level and rejects it, I enter in the breakout direction. If price closes back inside the old zone, there is no trade. This pound-dollar chart is the first fake. Price breaks a small descending trend line, and the candle looks strong. Then I mark the horizontal resistance, and price has not broken it. That means gate 1 opened, but gate 2 stayed closed. This is a pass. A trend line break alone is not enough. Now we are looking at S&P on the 3-minute. Price breaks below an ascending trend line after a failed push higher. Then it breaks the last support level, which is the level where price kept bouncing. Price comes back, retests that level from below, and rejects it as resistance. I sell the retest, not the first break. The best entry comes after the level proves it can hold. Now this gold chart looks valid at first, and that is why it matters. Price breaks both the diagonal line and the horizontal level before London. Then it comes back for the retest, but the candle closes back inside the old range, which means price is going sideways, stuck in a box. I pass this one. Note this down. A failed retest cancels the setup, even after both breaks happen. Okay, the rule gives you the entry gate. It does not show you how the setup behaves when real candles start moving fast. That is the part that matters. We are on NAS 100, 5-minute. Price is pulling back after a strong push down. I draw the rising pullback trend line under the candles. That is gate 1. I also mark the last clear support level. That is gate 2. Now price starts moving down. The candle breaks the pullback trend line, but I do not sell yet. I only have gate 1. I am waiting for the horizontal level because that is where buyers may still defend. The next candle pushes lower. Gate 2 opens. Now the setup is valid, but my entry still has to come from the retest. This is the part where scalpers get impatient and sell too early because they want to catch every tick. That is how a $100 account turns into a motivational quote. But this is a waiting game. And look, this candle touches the broken support from below, and it leaves an upper wick, then closes back down. That rejection is the trigger. I enter short right after. Stop goes above the retest wick. First target sits near the next structural low, which gives me a 3-hour trade. This clean version is the setup every scalper wants. But the real danger comes when the market shows the same shape in the wrong location. I'll show you. This is what I call the chop break, and it is exactly how the market steals your money. Watch what happens here. We have a market where price is not trending. It is stuck in chop, which means price keeps moving sideways with no clean pressure. It looks busy, but it gives you nothing clean to trade. The problem is not the trend line. The problem is where the trend line forms. If it forms inside sideways chop, the break has no clean pressure behind it. Price can break both levels and still go nowhere. So binary rule. If the trend line forms during a clear pullback, I allow the setup. If the trend line forms inside sideways chop, I skip it. Remember this part. A breakout, which means price pushes through the level, is not strong because a line breaks. It is strong because traders trapped on the wrong side have to act fast. That is why the failed retest is the kill switch. Skipping this filter makes you buy or sell straight into the trap candle. So here, price breaks the diagonal line. Then it breaks the horizontal level. At this point, it looks like the setup is alive. But when price comes back to retest, the candle does not reject the level. It closes back through it. That close matters. It tells me the broken level did not flip. It did not turn from resistance into support. The market did not accept the break. If the retest rejects the broken level, the trade stays alive. If the retest closes back through the level, the setup is cancelled. You don't want to guess. The candle close gives you the answer. So the edge comes from trapped traders. If price breaks support, retests it as resistance, and rejects, buyers who entered late are now stuck. When they exit, their selling helps push price lower. That is the human reason under the technical rule. Price moves faster when traders on the wrong side are forced out through the same level. This is your mindset shift. You are not trading a line. You are trading pressure. If those trap traders are forced to exit through the same level, momentum can continue. If price gives them room to escape cleanly, I skip the scalp. I made this mistake a lot of times, and you do it too. The break looks clean, but the retest gave buyers too much room. You enter, then price drifts, doesn't move much, and you sit there watching a trade that has no reason to move. A scalping trade shouldn't need hope. So we are back on pound dollar, 3-minute, and this is the trap test. I want this setup to almost qualify, because that is where real discipline shows up. Price is moving sideways before London. I marked the range high and range low first, because the whole chart is stuck between those two levels. Then I draw the small pullback trend line inside the range. Gate 1 opens when price breaks the trend line. I do not care yet. The trend line formed inside chop, and that already makes me cautious. Then price pushes higher and breaks the horizontal range high. Gate 2 opens, and for a moment the setup looks valid. This is where late scalpers buy, because they see 2 breaks and think the work is done. But I wait for the retest. As price comes back to the broken range high, these candles will make or break the setup. If a candle rejects the level and closes above it, I can allow the trade. If it closes back inside the range, the setup dies. Now look, the candle taps the level, it tries to bounce, then sellers push it back down, and it closes way inside the old range. That is the failed retest. No trade. This is the exact confirmation that will save your small account. Here's another one. The setup had gate 1, it had gate 2, but the retest failed, and that cancelled everything. Price drops back into the middle of the range. Then it moves sideways for 10 more candles. There is no clean scalp there. There is only noise and bad decisions dressed up as action. Most scalpers lose here because they want the chart to pay them for being early. But you are not being early. You are being used as exit liquidity, which means your order helps someone else get out. So binary rule, if the setup forms inside chop, or the retest closes back through the broken level, skip the trade. Now watch the difference. Later in the same session, price trends down, pulls back cleanly, breaks the pullback trend line, breaks the last support level, and retests it from below. This time the candle rejects the level with an upper wick. That one qualifies. The previous example was chop. This one is pressure. This is a valid short. Stop goes above the retest wick. Target goes at the next low. I don't need to babysit the trade because the retest did its job. Once you master this scalping strategy, the next step is learning how to grow your small account with it, without blowing it. That's your next video. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for.